Hello.
Hey, sweetheart.
Happy Sunday. My seat's up a little too
Happy
high.
Memorial Weekend.
Happy Memorial Weekend. Oh, yeah, I forgot it was.
Yeah, yeah.
Probably got a
Which
lot of
also
people in.
means, for those who do join us today, we
Right.
appreciate you spending your holiday with us. And for those who don't, we get it.
Yeah. Well,
We
and I
get it.
think I actually think that it's a good sentiment because Memorial Day really isn't about barbecuing and
Right.
partying. That's really not what it is. It's about people who sacrificed for our freedom, right? They went out and they fought for us.
Absolutely.
And I think, our biggest initiative is generational wealth. And so knowing that what you're doing today will have an impact later, I think is a hell of a tribute to someone who has also done the same thing, but with their life,
Right.
really. And which is far greater. I'm not comparing that, but I do think that anyone who is in here, I think they are also, they care about it. And that's important. That's significant. It makes a difference.
Very true. Very true. And yeah, so, and today, I think the topic for today is really just a continuation of what we've been discussing over these last few days. It's an example of what could be. It's an example of what there's a lot of people on social media saying you can do with your cash flow to be able to generate retirement income. And what I want to do is just compare and contrast what a lot of these social media influencers are saying. And they're giving real numbers and talking about real dollar amounts and just show what that would look like in a vehicle that might just be a little bit better.
Yeah. This is actually a trending topic right now, I think, because a lot of people just learned about cash value policies and using them as a vehicle to build wealth. This is trending because it's also a trending industry.
Very
So,
true.
are people talking about it because they understand that this is a strategy for building wealth, or are they talking about it because this industry, thanks to people like Bradley and others who talk about the I guess, profits that could be generated from being involved in the life insurance industry. Now you hear a lot more people getting out here talking about it. And are they using it for a wealth building strategy, or are they just showing you what people could do with it?
Right.
Probably hadn't even done it themselves. So that's first and foremost, is just who has the experience to understand these things as a strategy, or are they just kind of getting out here kind of like these side hustle people who never even tried them, but they will tell you how much you can make and you'll sit there and watch it, of course. Well, we have tried it. We know it works. We don't just try it. We have it implemented right now. And if you are looking for the fastest way to generate wealth, the lasting wealth, transferable wealth,
Right.
tax free income for life, then you're in the right place.
No, no doubt. And I think that's a part of the what I like to call fiduciary responsibility, meaning you're not going to hear us talk about something we're not doing. And I'm not saying that what we're sharing is the end all be all. I'm all for diversification, and there are many different answers to solve problems. But what we're going to walk you through is what we're actually doing and actions and steps that we're actually taking. Because I'm not going to talk about anything that at least I'm not going to have you do something that I wouldn't openly do myself. Right.
Yeah. So if you're watching, whether you're watching with us live or you're watching the replay, let us know, where are you tuning in from, and what is it that you are hoping to achieve for retirement income. And then maybe the next time we'll give you an example of how to reach that and the fastest route to get there. So
Yep.
today, oh, go ahead.
No, no, you got it.
Today we're gonna watch this video that was circulating. This is one of thousands that are out there right now, and it's pretty much saying the same thing. So we've seen these before, but the reason why we wanted to highlight these is because I think we need to think about things in a different way. Becoming self-directed really is all about educating yourself so that you can make educated decisions
Right.
in making whatever those opportunities are that come about, that you'll be armed with the information to make a decision and feel confident about doing that and reach your goal. So this isn't about managing risk. This isn't about having to become an expert at a stock market or real estate or whatever the case is. This is, we are into passive income, and we are looking for the least amount of effort to be able to get there, working smarter, not harder.
Absolutely. And to kind of just set this up a little bit, The video we're going to watch is, again, as she mentioned, there are many of these out here, so this is not unique. But it's one of the social media lights, I don't know what you call them, social media influencers, kind of walking through an example of what it would take for a 33-year-old to be able to retire with six-figure income. Again, 33 years old, retire with six-figure income. And he's going to walk you through his thoughts on how to best go about it and what vehicle would be best to use, or a vehicle that would be best to use. I don't disagree with anything that's being said in this video. I think how he sets it up is perfect. I think some of the criteria around what makes this vehicle strong and possible, spot on. It's just that the vehicle itself is not as efficient. So we'll get into some of the whys, but bottom line, it's 33, because he moves pretty fast. 33 years old, putting away a certain dollar amount to achieve a six-figure income. And that's basically what this is about.
All right, well, let's go.
Let's do it.
Okay. I should change the message on that. Like, we just started, and hey, if you learned something, hopefully you have. Hopefully what we're sharing, you are learning. Okay, let me go over here. I have to refresh this page
No problem.
because otherwise,
How much would a 33-year-old male, good health, need to put into an IUL to have $100,000 a year tax-free for retirement? Good question. Let's find out. Before we do, this is for educational purposes, and this is an assumed rate at 5.77. All right, so we got Jeffrey Dahmer. He's 33, young and healthy, so we're funding this for 20 years. Minimum death benefit, maximum cash value, and I get a lot of questions on why do we go minimum death benefit, maximum cash value. I'm going to go into a quick little lesson. One, the IUL is not just for the death benefit. Two, in order to receive all the tax advantages, tax code 72E 101A and 7702, the IRS requires that there needs to be a minimum death benefit in place. If you go under that minimum death benefit, this is now considered an investment and it's taxable income. Three, we use the IUL so we can utilize these tax advantages to be your own bank and to have a tax-free retirement. The cash value is what allows us to be our own bank and to have that tax-free retirement. So we want to put as much money as possible to build that cash value. We're going to go $2,500 a month. Policy year one, $30,000. $27,000 of the 30 is going into your cash value year one. Year 10, you'll have about $355,000. Year 20, we're done funding this, and you have a little over $1 million in your cash value. Right around age 60, you will be receiving $101,000 tax-free for the rest of your life. Your cash value is all accessible, and your death benefit is with you your entire life. This is the proper IUL strategy to structure your IUL properly for tax-free retirement and to be your own bank. How much would a 33-year-old male, good health, need?
Okay.
All right. So, lot there.
Yeah.
Again, 33 years old, putting away $2,500 a month. All you 33-year-olds out there, raise your hand if you can put away $30,000 annually into your retirement vehicle. I know a few, but I don't know that that fits the majority of us. And I'm not putting us in 30 years old. I'm just us in $30,000 annually being able to put away. Like, that's significant. But he's spot on. $2,500 a month, which is $30,000 a year being placed into an IUL that is max funded. Option B. Max funded, meaning we're purchasing the least amount of life insurance. So he's he's absolutely correct about that. Max funded, stating we're purchasing as little life insurance as possible. The reason we're purchasing as little life insurance as possible is so that we're spending the least amount in fees. The less fees you buy in a product like an IUL, the more money available to you to start producing income. He's right. So max funded. Option B, meaning you don't want a level death benefit. You want a forever increasing death benefit, meaning the more money you put inside this product, there's more money available to you building cash value. As you build more cash value, there's more income available for you to be able to use. And in addition to that, it increases your overall death benefit, which is two numbers: the life insurance plus the cash value. Spot on. And even the funding it for 10 years, what that dollar amount looks like. Funding it for 20 years, what does that dollar amount look like? Again, spot on. My challenge is, why so little in income? $30,000 a year is a lot.
Well, you know what we didn't do last time? We didn't really talk about what the heck is an IUL.
Okay. So an IUL honestly is just a type of life insurance. There's many different types of life insurance. There's first permanent versus term. What we're talking about is a permanent life insurance policy, meaning um, once, as long as you're keeping your policy in good standing, it stays with you forever. And if you pass, there's a death benefit that pays out. So permanent life insurance just means that it's permanent life insurance. There's many types. There's whole life policies, which you've heard a lot about. There's variable life, there's universal life, and there's index universal life. An IUL, index universal life insurance policy, is just a type of life insurance. Why is now all of a sudden everyone talking about an IUL when I think IULs had kind of had a bad rap? And the only reason why is because of that 0% floor that's built inside of an IUL. So if you were to lay out all of the cash value life insurance products, an IUL has this unique feature called a 0% floor. That unique feature is saying this: as you're putting money into your IUL, it's building cash value. Well, when you put that money into that IUL, it goes into this bucket called a general fund. And that general fund has this unique feature called a 0% floor. And what that means is it's a contractual guarantee. And that contractual guarantee is from the life insurance company. So it's a life insurance contractual guarantee that you can't lose the money that you've contributed into that general fund, meaning it is not impacted by market risk. If you were to just simply apply that strategy to a traditional retirement account like an IRA or 401k, imagine a 401k with a contractual guarantee that says as you put money in your 401k and it's riding with the market, when the market crashes, your 401k does not crash with it. Like, that's powerful. But that's what makes an IUL so powerful. So now if you can structure it properly, and the reason this is now a term is because in the past, people sold life insurance for the life insurance. They didn't sell life insurance to actually allow you a vehicle to produce income. Well, now people have kind of realized that, you know what, if we structure this to benefit the person buying it, there's a huge income benefit here. And so now that they are being properly structured, what you're seeing is this 0% floor with a properly structured cash value life insurance policy can actually do some pretty amazing things from an income perspective.
Okay. So what you're saying is that in the past, life insurance agents have really been selling death insurance.
Absolutely.
That this has really been a concept that says when you die, because it's the only guarantee we have, right? When you die, this is how much your beneficiaries will get. And that is the whole purpose of having life insurance. And so the majority of people see it as that is a vehicle. Death insurance is really what they've been using it for. And so talk to us a little bit about where this came from. We don't have to get into like the complete history, but who used to use these concepts, and why don't more people know that these concepts have been used for a long time to generate income and wealth while you're living?
I think you got to kind of also step back, because I'm not pointing fingers, nor do I think anyone is at fault here. Let's take me 20 years ago, because I had a term policy 20 years ago that expired. Luckily, I didn't die. But the money that I spent on that term policy went away. And I didn't renew it because now that I'm older, it would cost hundreds, if not thousands of dollars a month to be able to renew that policy. But when I walked into State Farm, I didn't walk into State Farm going, hey, do you guys have a retirement account that you can kind of structure for me so that I could actually do something better than what my traditional 401k is doing? Like, that is not why I walked into State Farm. Right. So nor did State Farm go, hey, come over here and let me show you how to do something better than your 401k. That's just not their business model. So I don't think that, this isn't to bag on life insurance agents or life insurance companies, because I just don't think that was the ultimate goal. We didn't know what we didn't know. Now, the life insurance companies knew that if you structured a life insurance product properly, it could do some amazing things. How did they know this? Because they've been using it for years themselves, along with banks. Banks have been using life insurance products for years, decades. On key individuals inside of their companies to be able to build cash value and grow wealth for their company. So this has been happening a long time. But as far as it being used for people like us, it's been there, but it's never been discussed, mainly because, especially when you talk about concepts like premium financing, where you're using kind of additional growth inside the policy to produce cash value. It's been there. It's been there since 1997. But the reason you and I didn't hear about it is because in order for us to hear about it, we needed a net worth of somewhere around $5 million. So wealthy individuals have had access to products like this for a long time. It wasn't until 2017 that it actually became available for people like us. And when I say people like us, it's just people who don't happen to have $5 million of net worth. So again, without getting into some of the reasons why and the specifics around that, that's ultimately it.
Okay. Well, I do think that it does need to be said that there's a lot of people who are in the life insurance business to help people set themselves up in a way so that it does benefit their families, and this life insurance has been known to create generational wealth and help
Absolutely.
people beyond. So, that part of the tool, and the reason why people still don't opt in is, I think, because of that YOLO. I'd rather live with them now. I'd rather have those experiences with them now. And they're
My
just
kids will
thinking,
be okay.
yeah, and they're just thinking of it a little bit differently and how it could be used.
Right.
But I think this is a game changer in talking about not only IUL as a strategy, but the difference in knowing that it's not all IULs are the same. And so that's
Right.
what you're going to talk about today.
Absolutely. Absolutely. Ready to jump in?
Yep.
Let's do it. All right. So what I'm showing is just basically a finalization of, hold on, where's my, there you go. What he had basically discussed in that video is putting away $2,500 a month. Again, $2,500 a month is $30,000 a year. I find it strange that he would choose a 30-year-old putting away $30,000 a year. That seems like a lot. But I think he was trying to the point he was trying to make was the goal is six-figure income. If you're wanting to make a six-figure income in today's climate, we have to be realistic about what it is we're putting away. So from his perspective, $2,500 a month will get us to that six-figure income goal. So $2,500 a month over the first 10 years, he would have put in 300,000. And what he said was, because, right, 30,000 times 10, $300,000 is what he would have contributed. He said at that point, you would have a cash value of about 355,000. So over that 10-year period, your money would have grown $55,000. Is that a lot? I mean, I think compared to a savings account, hell yeah, it's a lot.
Yeah.
But you can see that it builds slowly. Okay. And then at the 20-year mark, he would have put in $600,000. Well, at that 20-year mark, he would have a cash value of about $1 million, which is awesome. So almost double what he's contributed, meaning 2 compound cycles, right? Almost double what he's contributed. He has about $1 million over that 20-year period. And then at the end of the 20 years, he would have stopped contributing. And then by age 65, so from age 53 to 65, another 12 years. So by age 65, he would then have $101,000 tax-free for life. I think that's pretty awesome. I think who wouldn't want tax-free income at 6 figures starting at age 65? I think that's pretty awesome. My argument is, why do I have to wait till, again, I think what he was mentioning was this is a non-traditional approach to retirement. We just took a non-traditional approach, but he still responded with a traditional response. You have to wait till 65 before you can access your 6-figure income. And I call BS. Why do I have to wait till 65? In a vehicle like this that is non-traditional, there is nothing telling you have to wait till 65. It's a choice. So if you want to access that money sooner, you can access that money sooner. But to his point, the goal is 6 figures. Will you have 6 figures if you do that? Well, not in this vehicle, obviously, because you have to wait till 65 before you have $101,000 in tax-free income. What would it look like in another vehicle? So if you slide over to the other side.
Okay.
So in a premium finance strategy like MPI, premium finance is saying we're going to use leverage inside of this product to be able to produce more income. So in a premium finance strategy like MPI, same age, 33 years old, putting away, again, $1,500 a month, which I don't think is a small amount. And in the first 10 years, what does it look like? So 10 years, he would be 43 years old. So in 10 years, putting away $2,500 a month, he would have available to him, again, over that 10-year period. I did do 10 years, right? Yep, 10 years. Oh, I'm sorry. This dollar amount is wrong. It's not $1,500 a month.
It's $2,500.
It's $30,000 a year, which is $2,500 a month. My apologies. $2,500 a month over that 10-year period. He would have put in, again, the same $300,000. The difference between this product, MPI, Premium Finance Strategy, and a traditional IUL is all you have is your contributions and its growth. Well, with MPI, you have this growth or this leveraged amount of $663,000 that is added. This is a match being added to your policy. So you've put in $300,000, you're making on average around 7% on this amount. The $663,000 that you've leveraged, you're making around 3% on this amount on average. The growth on this amount plus the growth in this amount is what's producing this cash value of $428,000. So what was that a dollar amount at 10 years under the example that we had shared? Well, you've put in $300,000 over that period of time. And what he said was you'd have $355,000 in cash value, $355,000 compared to $428,000, which is better. Obviously, $428,000 is much better. So that's at the 10-year mark. Now let's go to the 20-year mark. Oh, one thing also to note is at that 10-year mark, if he wanted to, he'd have $45,000 tax-free that he would be able to take in income. And now I get it. $45,000 isn't six figures. But if you walked up to me on my 43rd birthday and gave me a tax-free check for $45,000, I definitely wouldn't turn it down and I definitely wouldn't be upset.
But this is also at a third of the time that the other example was.
Absolutely. This is at year 10. This is saying at year 10. So from age 33 to 43, at year 10, putting away $30,000 a year, you would have $45,000 tax-free available to you. If we were to add another 10 years. So at his point in the video, he said at the 20-year mark. Oh, that's 91. At the 20-year mark, he'd be 53. Mm-hmm. Again, putting in the same $2,500 a month. Notice the income annually at the 20-year mark. $184,000 tax-free for life at the 20-year mark.
It's a big difference.
It's a huge difference. So we're not talking about waiting till 65. What we're talking about is at the 20-year mark, you would have $184,000 in tax-free income. You would have put in $600,000. Again, same amount in the same amount as stated in the video, but you would have leveraged from the life insurance company almost or over $3 million. And again, approximately 3% growth on this $3 million plus the average 7% growth on this $600,000 is what would produce for you net cash value of about $1.6 million compared to the video where he mentioned $1 million total. So 1.6 million equates to about 184,000 tax-free for the rest of your life. Again, which one is better? And we're talking apples to apples, allowing the same dollar amount to compound for the same amount of time. Now, his difference was once you stop contributing at age 53, you wait another 12 years before you can start taking your income, which would give you about 101,000. I don't even want to look at what an additional 12 years of compounding would do inside this product because it would be borderline ridiculous. But the moral of the story is instead of, again, this is a non-traditional approach. This is not an IRA. This is not a 401k. Taking a non-traditional approach, I would expect to have a non-traditional way of being able to produce income for life. And in that non-traditional way, that means, why do I have to wait till 60? Why do I have to wait till a traditional retirement age? By age 53, I'm able to take 184,000 tax-free. And hey, let's how about this? Let's back this number down a little bit. Instead of 53, what would it look like at, let's say, 50? That's $130,000 tax-free for life. It's still, so it's 15 years earlier than what this original video was mentioning. 15 years earlier, you're able to take 130,000 tax-free for life. Like, it's a no-brainer to me.
Yeah, it's pretty significant to think that these opportunities or these options are out there, and we're just limited by who knows to share them.
Right.
Really, the difference. It's the same amount of money, the same amount of time. But let's say I were to invest in this IUL and you were to invest in MPI plan, and we both get to that same amount of time passes for both of us, and we come together and we go, great, we have 6 figures in income. This is going to be awesome. We are definitely set for life, tax-free, loving it. And I'm looking at, in the meantime, I was not able to leverage it. You could have leveraged it to buy a house. How else could that have looked different? Because I'm thinking $2,500 a month and you can't leverage any of those funds. Where's the down, if you're 30, right, when you're starting,
Yep.
Where's the down payment for your home? Where's your kids needed something? Where's I need a new car? Like, you don't become your own bank this way, truly, because you can't leverage this money without it impacting what that end result would be in decades from now.
Right. So if we were to just go back to the 10-year mark, at the 10-year mark, you would have an asset available to you of about $428,000 in cash value. That's a total of about $45,000 in income that you're able to take. I'm not saying you're going to touch the income at all, but to your point, it's time to build that dream home. That dream home costs $500,000. Putting down 5% on that $500,000 is what, 25 grand? Where are you going to get that $25,000 from? You can't get it out of your IRA. You could get it out of your 401k, but there's going to be stipulations associated with that. You can't get it out of your 403b. So from a traditional retirement planning perspective, where are you going to get that $25,000 from? Hopefully you built up your emergency fund throughout this period. But if you're putting away $30,000 a year, more than likely that is your emergency fund. But in this case, you've got a $428,000 asset that's available to you to do whatever you want. So if your goal is to be able to use 50 grand to put down on your dream home, and not put yourself into a high credit card situation, or a situation where you're leveraging other things in your life to be able to accomplish, you have an asset that you can leverage to be able to use whenever you want, however you want.
Yeah, and this is not new, right? This concept
Not new at all.
is not new.
Not new at all. Now, I think what I also wanted to do was let's be a little bit more realistic.
Yeah.
Because in this video, he talked about a 33-year-old putting away $2,500 a month. Okay. And I think, again, I get it. Why? Because the goal was a 6-figure income. Well, but what's more realistic? I would think at 33 years old, I think for me, putting away maybe $500 a month would be a bit more realistic. $500 a month, $6,000 a year is way less than $30,000 a year. Well, if he was to be able to do that, again, 33-year-old putting away $500 a month, $6,000 a year. Oh. And let's just go to the end, allowing that to compound till age 65. So using that non-traditional age again, allowing the $500 a month to compound till age 65, he would have put in $192,000. So definitely not $30,000 a year, bit more manageable, $192,000 a year, over that. What is that? How many years? 33 to 65 over that 32-year period. Over that 32-year period, he would have put in $192,000. He would have leveraged from the life insurance company about $1 million. Again, the growth on this dollar amount plus the growth on this dollar amount is what would produce a liquid cash value of about $1.1 million. This is an asset that he is able to use and do whatever he wants. And that asset would produce right around $113,000 tax-free for the rest of his life. And again, in this video, it was $101,000 by the age of 65. So this is still more, putting away $500 a month, which is a bit more realistic. And then imagine, again, this is not a this or that, it's an and. So if he's got a traditional retirement account with his company and maybe Social Security is still around, or, maybe he did crypto, or maybe he bought precious metals, like in addition to everything else that's being done, stay consistent and put away $500 a month, $6,000 a year into a secure compound interest account, which still gave him a six-figure income by the age of 65. What's
That's
better?
a game changer.
What's better?
So I agree that these examples, some of the examples that are out there do seem unrealistic, especially if you are getting into the game later. But just coming up with $1,500 or $2,500 a month is not realistic for most people. However, I do think that if you have this idea, if you understand the whole principle, then you can structure what it is that your finances look like, to understand the power of what would an extra $100 do, what would an extra $500 do inside of a vehicle like this. Because in 20 years, let's just say the plan is you're planning to move somewhere and you will need to have leverage at some point. Saving is not going to help you get there. But if your money is making its own money, that's where I think the disconnect happens, is they see the number that's being saved and they have access to it at any time, which feels like security, right?
Right. And, when I talk to I'll call it the age range of 20 to 35, usually the message that I try to send is it's really about getting started. It's really not about, hey, I'm not in a position, like if I was 33 years old and this was presented to me, I am not in a position to put away $30,000 a year. It is not about putting away $30,000 a year. It's about understanding your cash flow. And in order to understand your cash flow, you have to understand your numbers, right? Income, debt, expenses, what's my cash flow? If you can understand your cash flow, it's what is it you're capable of doing and what is realistic. And usually it's around 10% of your income is what will allow you to achieve your goal at retirement age. So if you're making $30,000 a year, 10% of 30,000, $3,000 a year. 10% of 50,000, $5,000 a year. So usually it's right around that 10% of your income if you're between that 20 to 35 range. When you're approaching that, I'll call it 33, 35 to, 50, you have to be a bit more realistic around, hey, I don't have as many compound cycles as a 20-year-old. So that means I need to be a little bit more aggressive. Well, maybe it's a little bit more than 10%. Maybe it's more like 12, 15, maybe it's 20%. But it's really about getting started, because once you get started and once you see this vehicle start to grow the way that it grows, then you're trying to figure out, hey, where can I get more money to dump into this thing to make it compound even faster? So it's about getting started. So maybe you can't do 10%. Can you do 5%? That bare minimum is right around 10 times your age. So for a 33-year-old, that bare minimum would be $333 a month or $330 a month. So what would $330 compared to $500 a month look like inside of a product like this? $330 a month is still a $74,000 tax-free income for the rest of your life. You still have an asset that's worth $735,000 on top of everything else that you're doing. Like, where's the harm in that? Right?
That you can leverage.
That you can use to do whatever you want. You want to go buy a Tesla for your 50th birthday? That's where you leverage the money to go do so. You want to build your dream home? That's where you leverage the money to go do so. Hey, things took a turn for the worse, and now you have this medical bill that needs to be addressed, and your HSA account doesn't have enough to be able to manage. Well, guess what? You have this dollar amount here that you're able to leverage to also take care of that health issue, whatever the case may be. So this is a liquid, living, breathing asset that you're able to use and do whatever it is you want.
Yeah, I think that's the most important thing. If I'm listening and I'm just hearing this type of stuff for the first time, I think, why do I care about this versus something else? Why is not even on my radar right now what some of those issues are that people face when they're older, right?
Right.
So I think that really saying it's not just about like this fear of what if these things happen, then you're prepared, because that's really where the insurance industry thrives, right? It's the what if. It's the fear of, if something happens, you don't get to choose when it happens, but if something happens, that everything will be okay. And I
Right.
think the stock market and all these money markets are not set up in the same way. They are, if things go good, right, you could benefit. It's the complete opposite. So maybe it's, are you a glass half empty or half full type of person, and how do you think that this benefits you might be a good question to answer. But I also have this other one. It's really in, when you talk about leveraging these strategies along the way, right? So why can you leverage this and you can't leverage an IUL the same way?
Well, actually can. So the cash value is growing similarly. Matter of fact, I think I've got a visual for that as well. So if you slide over to the other screen, I think I can kind of highlight the reason why. 'Cause I think you bring up a great point. So when we talk about growth inside of an, I know, and I hate this color, I get it, a little bit hard to see, but when we talk about growth inside of an IUL compared to growth inside of a premium finance strategy like MPI, the difference is leverage being used inside to grow the cash value faster. So you still have the ability to use that cash value to buy a home, buy a car, pay a bill, just like inside of premium financing. The issue is the amount. The issue is how much leverage is there. And leverage inside of an IUL, again, if we were talking about $500 a month, which is $6,000 a year, leverage inside of an IUL, what's happening is your money is making on average 7% on average. And again, there are different types of IULs. There's different type of caps and uncapped. Like there's many different types, but on average, the growth inside of a traditional, properly structured IUL is around 7%. Well, inside of MPI, you're making the same 7%, but then you've got this leveraged amount. This leveraged amount is costing you 4% to use, but it's making 7%. Which means you get to keep on average 3% of this leveraged money. And it's these $2 amounts added together is what blows a traditional IUL out of the water. So it's not that you can't leverage an IUL the same way. It's just that your cash value isn't growing as fast. And again, it's that uninterrupted, secure compound interest, which creates exponential growth inside of the policy that sets this apart from other traditional retirement accounts and other IULs. So it's not that IULs are bad. Again, it's really about structure. If we're talking apples to apples and the IULs are structured the same, they're going to perform around the same. The difference between MPI, which is a premium finance strategy, is it's adding leverage. Where does that leverage come from? Well, starting in year three, again, if we're doing $500 a month, over in year one, $500 a month in year two, well, starting in year three, you're able to leverage everything from year one. So what's added here as far as leverage inside of your policy is all of the growth that was accumulated in year one. And then in year four, you're going to do the same thing again. You're going to add additional leverage from year one. But in year five, something special happens. Instead of only leveraging year one, in year five, you're going to leverage years 1 and 2. That's $12,000. And then in year 7, you're going to leverage years 1, 2, and 3, $18,000. And then in year 9, you're going to leverage years 1, 2, 3, and 4. And it exponentially continues to grow. So year 11, year 11, you're leveraging 1, 2, 3, 4, and 5. Year 13, 1, 2, 3, 4, 5, and 6. It starts to exponentially get bigger. So I'm showing $120,000 right now, But this number becomes so large that it's actually the growth on this leverage, 3% growth on this leverage becomes more than 7% growth on all of your money. So this is where the bulk of your growth comes from, which is why a traditional IUL can't compare.
So if you were to borrow along that 10, somewhere within that 10 years,
10-year
though,
period.
what's the difference of if you were to borrow from a traditional IUL, even if they're doing it max funded option B,
Yep.
with
Yep.
this schedule, what would be the difference? Why is it that MPI is leverageable versus an IUL?
Hold on. We got to call this out here. Well done on the max funded option B. Well done. Well done. Because you're right. It has to be properly structured, and it has to be max funded option B in order for it to be properly structured. So what's the difference? Well, let's just use these dollar amounts. So let me get rid of this. So you've got $60,000 sitting inside. You got $60,000 sitting inside your IUL, and you need a certain dollar amount to, do some type of real estate transaction or put a down payment on a home. So you're wanting to leverage, let's call it 10%. So you want to leverage $6,000 to go do an opportunity. You absolutely can. And the repayment schedule around that, meaning it's $6,000, it would cost you around 4% to borrow this money, and you can use that 4% to go do whatever you want. Ideally, you would be doing it to either pay a bill that's greater than that 4%, or buy some asset that's making you more than 4%. But the process is the same. Well, if you needed 10% from your MPI plan, well, 10% of 180,000 is 18 grand. So you're just able to leverage more. So it's not that you can't do it. It's just that the amount that's available to you just happens to be more because one grows faster than the other. And there's not a time frame on when you can leverage this money either. If we were just talking about year 3, at year 3, you've put in 18,000 inside of your IUL in total. Oh, I didn't mean to do that. At year 3, you've put in 18,000 total inside of your IUL. Well, at year 3, you've put in 24,000, 18,000 of yours plus 24 plus another 6,000 from the life insurance company. So you put in 24,000 at year 3. If you needed some dollar amount to go pay a medical bill or get a car fixed, you have access to that money in the same fashion. It's just one happens to be more than another because there's a match involved. There's extra money being included inside of this policy that is not being included inside of an IUL.
So what I'm hearing, though, is that if you were to disrupt an IUL, then what you think you're going to have in income could be impacted. And so therefore, if you don't pay it right back, which if you need to leverage that money, the chances of you paying that right back, right, would not be probably very high. So if you are impacting the overall, then the person who told you this is what the plan is, if you're not understanding when they say, and you can leverage it at any time, but you're not understanding how that would impact the end result, you're going to get to the end and go, well, hold on a second. You said I could do all these things, and you said that this would be producing me this amount of income. At some point, you may be faced with a decision of this or that.
Absolutely. And this is for my infinite banking people, right? A lot of times people who use whole life policies or IUL policies say if you're going to treat your money like a bank, then you also should take the same approach that you would with a bank, meaning if you're leveraging money from the policy, you should pay that back. And I'm going to argue the same inside of a premium finance policy. If you're leveraging money from yourself, you should pay that back. The difference between the two is inside of a whole life policy or an IUL, you have to pay it back, because if you don't, you're right, your policy could start to eat itself. And here's what I mean. If you're leveraging some dollar amount over time and you're not paying that money back, if you're not making more than what you've taken, you start to create a deficit inside your policy and it could start to eat itself. Whereas if you have a policy like a premium finance strategy, also known as MPI, because the growth inside the policy is more than it costs to use the money inside the policy, there's no, I'll call it the likelihood of your policy starting to eat itself isn't there. And so therefore you have an option to pay it back or not, because the growth inside your policy will continue to grow and continue to make money for you, even if you have not made one payment back to yourself or to the life insurance company, in essence. So you do have that option, meaning it is available because of the structure of this policy, and the leverage growth inside of this policy allows there to be enough room and enough growth to be able to compensate for anything that you've taken out of it. And again, you don't have that capability inside of an IUL simply because you don't have that match feature, simply because even a max funded option B IUL is still somewhat inefficient. And here's the evidence. Here, let me come back over to here. Here's the evidence of what it is I'm saying. Notice, let me come on here. Yeah. Notice, inside of the IUL, at age 33, you would have been putting in $2,500 a month, which is $30,000 a year. Over a 10-year period, you would have put in $300,000. What I usually tell people is the way you want to know whether or not a policy is properly structured is by understanding when it breaks even. Meaning, when does what you've put in it equate to what's working for you? So I've put in $1, I have $1 working for me. What is that break even point? Notice in this video, the break even point is 10 years. Meaning it took 10 years for his $300,000 of contribution to equate to $300,000 of money available to him to be able to use. And I get it, there's a $55,000 difference, but I think we can agree it's approximately 10 years for him to break even. Well, what was that break even point for a premium finance strategy like MPI? If at 10 years, he's got 428,000, that break even point, and I can show it in the calculator, but I can tell you that break even point inside of MPI is year 3. So at year 3, you are in a position to now start leveraging money in your policy and not impacting the growth.
That's infinite banking.
Absolutely. Versus inside of an IUL, even though this IUL is properly structured, it's just not an efficient product that would allow you to be able to leverage the money in it at year 3 and not impact the growth.
Yeah.
It's just the difference in product. And it's simply because of the leverage piece. It's simply because of using other people's money to be able to grow your account exponentially. It's what makes the 401k better than an IRA. The 401k is better because you're using other people's money, your company's match, to exponentially grow your account. Now, the product itself is a little bit inferior. You know, we can talk about that. But what makes it better is the contribution amounts and the ability to use someone else's money. This is no different.
Okay, I do see there is something here though. It's
There's a lot here.
like for instance, match is often attributed with free money. People might also classify tax-free growth as free money, right? You didn't have to do anything for it. You just set your money there and you get income tax-free, right? So that's free money. They might put that in the bucket. But I do think that it's that understanding why these systems are in place, why this income is free, why an employer would want to set up a match. I think why this makes sense at all, because why wouldn't they just give you more income than offer the match, right? Why would it be? And on top of that, it means in order to get that match, in order to really maximize what that opportunity is, you have to put in a certain dollar amount too.
Not only that, you also have to be at the company for a certain period of time before all of that stuff even becomes yours, right? Because a lot of times there's this grace period of, 5 years, vesting period of 5 years or whatever that time frame might be before you can even have your money. So, you're spot on. And the easy answer to the question that you're asking is who benefits?
Yeah.
Right?
Yeah.
Who benefits from you tax deferring your dollars? Who benefits from, hey, this company is offering me a 5% match? That's called free money. Is it though?
For them.
Right. But for you though, is it really free? Or is it something that you're going to end up paying taxes on in the future at some rate that you didn't even realize even existed?
Oh.
The tax rate we're paying today, no one 20 years ago we'll be paying this tax rate today. This is an unheard of tax rate.
not only that, but the amount of money that you put in, that dollar could be worth, based off of the market, that dollar could be worth
Inflation.
20, 30 cents
Right.
in a few
Inflation.
years. So,
Right.
right. So, well, not just inflation, but just market value.
Fair.
Right? So,
Fair.
whatever you think your account is overnight, it can reduce. And there's, because there is no 0% floor like there is with these strategies. And so, that risk, I think the diversification that a lot of people talk about in managing risk is because these systems are in place not for the end user. So the end users having to jump through hoops, having to find hacks and tips and tricks and different ways of managing risk. But what is the risk to these companies? Why are these systems in place? And I'm sure we could go on a complete rant and do an entire live stream about that. But I think the point is that they are in place for a reason, that the end user is not at
The
the forefront
beneficiary.
of the benefit.
That's right. That's right.
And all of the risk lies with them, lies with us, you and me and
Absolutely.
everyone watching.
And just so we're clear, the free money part, meaning all you got to do is put your money here and this money is free. And that's not 100% true either, because the way Roth items work, Roth vehicles, whether we're talking about a Roth IRA, Roth 401k, or a product like an IUL or MPI or another cash value life insurance product that's growing tax-free dollars.
Yeah.
Your job is to pay taxes on the money that you're putting into the product. So there's still a tax implication, but I would much rather pay the taxes on the dollar that I have today because I know the tax rate today versus writing a check to pay taxes on some dollar amount that I have no idea what the tax rate will be in the future. So the role you play, your obligation is to pay taxes now and then put it in a vehicle that's growing tax free.
Okay, I have a question.
Go ahead.
If you were to take money out of your 401k, like a loan, right? Because no
Borrow against
different
it.
than these options, you're still taking a loan out of your policy. So
Absolutely.
a loan out of your plan, a loan out of your retirement account. Let's just say that.
Yes.
It's the same thing. So there's some people might see that the loan is no different than a penalty or a taxable penalty too, right? So maybe
Right.
there's not that part, but interest.
Right.
Being
So
paid.
you borrow from your 401k or you borrow from a cash value life insurance product, there's a cost to borrow.
Yeah, there it is.
And that cost to borrow inside of a traditional retirement account is required to be paid back within 5 years. Required to be paid
Okay.
back within 5 years. That cost to borrow inside of a cash value life insurance product is optional to be paid back over time. So one, it's optional. Two, there's no time frame that dollar amount has to be paid back. So, but what allows the money to be tax free. So there's an interest implication, but they're both tax free dollar amounts because you're using leveraged money, and leveraged money can't be taxed.
Okay, but who gets the interest?
Yep. So inside of a cash value life insurance product, well, let me use a 401k first. Inside a traditional retirement account, you are actually borrowing from yourself and you're actually paying interest back to yourself. So this is different for a traditional retirement account compared to a cash value life insurance product. In a cash value life insurance product, you're borrowing money from the life insurance company, and the life insurance company is using your cash value as collateral. So when you pay the interest back, you're actually paying it back to the life insurance company for the money that you borrowed. So the cost to borrow that money from them, you're paying it back to them. What happens if you don't? Well, if in a properly structured policy, if you don't, when you pass away, whatever that deficit is going to come out of the death benefit before it goes to your beneficiaries. But in a poorly designed cash value life insurance product, that that cost to borrow could become so significant that it eats into your cash value and it impacts your ability to take income while you're still living. So it could your ability to get income out of it now, which is why from your infinite banking gurus, they say you want to make sure you're paying that dollar amount back because you don't want to impact your ability to be able to leverage that money over and over and over and over again.
Yeah.
But if it's properly structured, it won't impact the growth like that. But then you're still going to have to pay the piper. You're still going to have to pay that interest at some point, and that interest would come out of the death benefit once you pass.
Got it. Okay. So we're almost right at the hour. And I think if I were to ask any more questions, I'd be kind of moving into a different topic. So I don't see any questions today. So maybe and it's Memorial Day
It's
weekend.
holiday weekend. Get it?
Yep.
Someone they're out there throwing frisbees at the park. So, but one thing I do want to mention though is we talk a lot about action, processes, action, structure, which is all awesome. I think one of the pieces that we don't spend a lot of time in, and I think it's definitely required of anyone who is wanting to look at different options as it relates to a secure compound interest account, or even traditional retirement planning, or even a self-directed retirement account. It's about mindset. One of the questions that I get all the time, matter of fact, this specific example, I have a client that is close to this $2,500 a month, not really fully, but close to it. He struggled a lot understanding how this product is able to do what it's able to do because of the conditioning. Like, we've been marketed to since children that banks, financial advisors, and life insurance companies have our back. That if we just follow whatever the prescription is for achieving retirement income is, if we follow that, everything will be okay. And so it is very difficult. It is a challenge for us to mentally get over the fact that, you know what, these institutions don't necessarily have our best interests at heart. And it's not that they're wrong to me. And again, I'm not calling anyone's baby ugly. I'm not saying that we should do away with financial advisors. None of that. What I am saying is we need to understand that these institutions are capitalist. These institutions are about a dollar amount. We should look at it the same way. Banks don't care about us. They care about the dollar. We should look at the bank the same way. We should leverage the bank the way the banks are leveraging us. We should leverage the life insurance companies the way the life insurance companies are leveraging us. And we should have a different discussion with our financial advisors. Our financial advisors do not have all the answers. Our financial advisors sell products. So when you're talking to your financial advisor, talk to them about those products. But when it comes to understanding whether or not they have all the answers to be able to achieve the income that you want, they don't. And I think that's the piece that I don't want it to get lost here. If you take action inside of a vehicle like premium finance strategy, yes, you can produce a significant amount of income. That doesn't stop you from tossing and turning at night going, did I make the right decision? Man, I haven't heard much about premium financing. Is this the right tool? My financial advisor told me that IULs are bad. You have all of that stuff fighting against, and it's tough. So I think that mental gymnastics that you have to play in order to get yourself in a position to be able to go, you know what, these vehicles are the right vehicles, I think that's a piece where we should also spend more time discussing as well on this.
Yeah, couldn't agree more. So, if I think what you're also saying though is redefining security, not just the
Absolutely.
not just the journey to achieving security and what avenue you're selecting. There's a slow and fast. I mean, there's a lot of different options out there, but I think the majority of people want to know that, hey, I'm going to get there. This
Right.
is not a when, this is not an if, this is not a, I hope this works. This is not a, if I can learn enough about this industry, like real estate, for instance, and I understand where the opportunities are and are not, and where the risks are and are not, or where I could actually lose a lot of money. I don't have to think of anything like that. If I'm using these strategies, because now I'm self-directed, now I can become my own bank, now I'm leveraging my plan. I'm
in
not having to go
control.
to the bank and be at the mercy of somebody else making decisions on what opportunities I have available to me. I
Right.
really appreciate that. So in redefining security, I think that brings us right on, there's a full circle moment, right on back to becoming self-directed. Because when you do understand what these concepts are, when you do understand the why these systems work, where your leverage is, then when opportunities come at you, you will be able to recognize them.
That's
And
it.
not just, they won't just pass you by.
That's it. That's it. Take us home, sweetheart.
All right. Well, thank you guys so much for tuning in. For anyone who has been joining in, we see we have a couple people on LinkedIn, YouTube, Facebook. We appreciate you all for tuning in. Hope you all have a wonderful rest of your weekend. We've changed the time, so let's just throw that out there. From now on, for this next month, we're going to be on Wednesdays at 6 p.m. Pacific Standard Time and Sundays at 1:30-ish Pacific Standard Time. So if you would like to join us, if those times would work better for you outside of like it being holiday weekend, right? Then let us know. We're just trying to make sure that everyone has a chance to join in.
Yep. And in addition, if you would like your numbers run, I spend a lot of time. What I love about these videos is they are putting it out there. Hey, here's what I'm doing. And what I like to just do is compare and contrast. Hey, here's what they say they're doing. Here's how they say they're growing. Is that the right vehicle or not? But if you would like to just understand, you know what? I am X age, and if I put away X dollar amount, what would it look like for me? Not saying I'm even in a position to do that right now, but just, hey, what would it look like? Please, I would be happy to do so. And it doesn't take much. I can back into what that income would look like with the smallest amount of information. And it starts with, hey, how old are you? What's your desired retirement age, if there is one? And what realistic are you able to put away? Maybe you don't even know. I'd back into that number by taking 10 times your age. Or if you share with me, you know what, I make $45,000 a year, I'm X age, I would back into that number by taking a percentage of your income. So there's not a whole lot of information required, but if you would like your numbers run to understand how a product like a self-directed 401k, the self-directed IRA, an MPI plan, an IUL, you're thinking of refinancing and you want to know if a first position HELOC might be best for you, the easiest thing to do is to reach out to us, and we will happily kind of anonymously run your information and show you exactly what that would look like.
Yeah. All right. So, and if you want to learn more, if you don't want to wait till the next live stream, then we have some free resources and a way that you can start educating yourself on what this is. Most importantly, though, answering the question, why does everyone end up poor? I think this is a great book. If you haven't read it, you've got to read it. And here's how you can get it for free. You ready?
Let's do it.
All right. Thanks for joining.
Get self-directed.
Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you get
Get self-directed.